The insurance sector is made up of companies that offer risk management in the form of insurance contracts. The basic concept of insurance is that one party, the insurer, will guarantee payment for an uncertain future event. Meanwhile, another party, the insured or the policyholder, pays a smaller premium to the insurer in exchange for that protection on that uncertain future occurrence. As an industry, insurance is regarded as a slow-growing, safe sector for investors. This perception is not as strong as it was in the 1970s and 1980s, but it is still generally true when compared to other financial sectors. Key takeaways: the insurance industry is made up of different types of players operating in different spaces. Life insurance companies focus on legacy planning and replacing human capital value. Health insurers cover medical costs, and property, casualty, or accident insurance is aimed at replacing the value of homes, cars, or valuables. Insurance companies can be structured either as a traditional stock company with outside investors, or mutual companies where policyholders are the owners. Owning equity in an insurance company may lead to dividends, inflation protection, and stable company revenue. The industry sector is highly regulated, which may protect investors while also creating compliance barriers that may limit growth opportunities. How insurance companies work: the insurance sector is fundamentally rooted in risk management. All policies written are analyzed with various risks considered. An actuarial analysis is performed to better understand the statistical likelihood of certain outcomes. Based on variances between statistical data and projections, policyholder premiums are adjusted or benefits are reevaluated. In general, premium amounts paid within the insurance sector are a function of the risk associated with the related individual, property, or item being insured. One of the more interesting features of insurance companies is that they are essentially allowed to use their customers' money to invest for themselves. This makes them similar to banks, but investing happens to an even greater extent. This is sometimes referred to as the float. Float occurs when one party extends money to another party and does not expect repayment until after a circumstantial event. This mechanism essentially means insurance companies have a positive cost of capital. This distinguishes them from private equity funds, banks, and mutual funds. For investors in stock insurance companies, or policyholders in mutual companies, this means the potential for lower risk, stable returns. Main types of insurance companies: not all insurance companies offer the same products or cater to the same customer base. Among the largest categories of insurance companies are accident and health insurers, property and casualty insurers, and financial guarantors. The most common types of personal insurance policies are auto, health, homeowners, and life. Most individuals in the United States have at least one of these types of insurance. And car insurance is required by law. Accident and health companies are probably the most well-known. These include companies such as United Health Group, Anthem, Aetna and Aflac, which are designed to help people who have been physically harmed. Life insurance companies mainly issue policies that pay a death benefit as a lump sum upon the death of the insured to their beneficiaries. Life insurance policies may be sold as term life, which is less expensive and expires at the end of the term, or permanent, typically whole life or universal life, which is more expensive but lasts a lifetime and carries a cash accumulation component. Life insurers may also sell long-term disability policies that replace the insured's income if they become sick or disabled. Well-known life insurers include Northwestern Mutual, Guardian, Prudential, and William Penn. Property and casualty companies insure against accidents of non-physical harm. This can include lawsuits, damage to personal assets, car crashes, and more. Large property and casualty insurers include State Farm, Nationwide, and Allstate. Businesses require special types of insurance policies that insure against specific types of risks faced by a particular business. For example, a fast food restaurant needs a policy that covers damage or injury that occurs as a result of cooking with a deep fryer. An auto dealer is not subject to this type of risk but does require coverage for damage or injury that could occur during test drives.